There are moments in sports that feel bigger than a single game. Moments like resolution. For Seahawk fans this year's Super Bowl felt just like that. As you all know, because it all got shoved down everybody's throat for the last 2 weeks. Years ago, we faced the same Patriots on the biggest stage and lost in a way that still stings. This year, though, was different. Total redemption. Same opponent, higher stakes, and this time Seattle just didn't win. They made a statement.
You've been waiting a decade to open a podcast like this, haven't you, Dave?
I admit it, I have. But what struck me wasn't just the win. It was how misleading the pregame narratives were. On paper, both teams looked evenly matched. Analysis debated averages, rankings, and probabilities. But the game wasn't decided by those. It was decided by execution in the moments that mattered.
And which is exactly where today's conversation begins.
Welcome to More Wealth Retirement Talk, where finance meets fun.
Join financial expert Shawna Moore,
sports analogy pro and dad joke king Dave Moore,
and Jacqueline Gladhill, who keeps us all on track
as we break down retirement planning with insights,
laughs,
and a whole lot of more wisdom.
Welcome to More Wealth Retirement Talk, where we explore how thoughtful planning, intelligent strategy, and discipline decision-making shapes a truly confident retirement. I'm Dave Moore.
And I'm Shawna Moore.
And I'm Jacqueline.
Sup, Jacqueline?
How are you doing?
Yeah, how are you, Jacqueline?
I'm pretty good. You know, I mean, like I kind of mentioned before, my monster-in-law drama, but we're getting past it. We'll get through it. How about the two of you? Happy as always. You know, last year I did make a joke. Okay. Last week, I did make a joke about how you guys were either going to be super depressed or the happiest people on earth. So which one is it?
Let's just say we're super happy.
Super happy. Happiest people. And the parade's going on today,
too. The parade's going on as we speak. That's right. We should be there, but we're here with you all. So each month.
Sorry.
No.
And today is someone's birthday.
Friday.
And
so we got to talk about the parade different because we said the parade was yesterday.
Okay. Say the parade was on Wednesday.
Oh,
yeah. So let me say that. Yeah.
Okay.
And we got to watch the parade on Wednesday, which was very exciting.
That's right.
Up in Seattle.
How awesome is this week?
This is a great week.
Yes, and there's someone's birthday this week that we got to celebrate.
That's right. Jenna Moore, if you're out there, 18 years old today.
Woo! I think we have a little
Happy
song
birthday.
for her.
It's my birthday.
Woo! Yes, 18 is a big one. So super exciting. And overall, this week has been super exciting. Seahawks win and, now Jenna's birthday and the parade, all sorts of things. And keep in mind, today is Valentine's Day.
Every day is Valentine's Day, Jacqueline.
Yes, it's Love Month.
Yes, it is Love Month. Love our hawks. Love our wives. Love our daughters.
Mm-hmm.
Love our dogs.
Our dogs, yes.
Yeah.
Your co-dogs.
Yeah,
yes.
I was going to say co-host. I was going to include Jacqueline in there, but he had to go with dog.
Jacqueline. Yes. This is our first Valentine's Day with Jacqueline.
It is.
Yes.
Yeah.
Happy Valentine's Day, everyone.
Well, each month we focus on one central idea that quietly influences almost every retirement decision. This month's theme is, drumroll.
Wait.
The myth of average returns.
Yes. And last week we explored why average can be one of the most dangerous assumptions in financial planning. So today we're bringing that idea to life through a story, because for many families, it's not the math that changes perspective, it's the experience. So I'm going to give you a story about a client of ours. We're just going to call them Jim and Pam for today. But when Jim and Pam first came to us, they were already a few years into retirement. They had an advisor, and on paper, everything looked fine. Their previous advisor had built a traditional portfolio. They set it on autopilot and essentially told them, just stay the course, don't make any changes, the averages will work out. But here's what actually was happening beneath the surface. So there was no market crash, no dramatic headline, no single moment of panic, but instead there was a quiet but dangerous pattern. So through those years, there was a sequence of modest declines followed by uneven recoveries. So we've had that in the last few years, some small dips in the market, and it kind of goes up and down. But they also had withdrawals increasing each year to fund their lifestyle and their income needs. They had rising taxes as distributions accelerated. They had inflation, which steadily erodes purchasing power, and then healthcare costs that are climbing faster than they had projected. But the most concerning part, their portfolio had never been recalibrated or adjusted for the reality of retirement. So by the time they sat down with us, their plan wasn't just outdated, it was kind of actually drifting off course. And I remember Jim said something I'll never forget. He said, our portfolio doesn't look terrible, but something just feels off. It feels like we're moving forward, but with less certainty every year. And that's when we knew and they knew that the real issue was not performance. It was that the myth of average returns colliding with real life had a different output, because averages don't account for timing those withdrawals. They don't account for taxes, inflation, or longevity. And most importantly, they don't protect those that are retired from silent erosion. And that's the difference between a portfolio that may look good on paper and a retirement plan that actually works in real life.
Right. So they didn't make reckless decisions or overspend. And they also didn't chase any risky investments.
Exactly. They actually followed what most sophisticated investors are told to do. So the problem was not their behavior, it was the assumptions.
It's interesting. High net worth families often assume they're protected from these issues because their numbers are larger.
Exactly. But scale doesn't eliminate risk. It actually magnifies it.
Kind of reminds me of Seattle season. Analysts look at averages. We've heard that all week long. Yards per game, efficiency metrics, projections. But the Seahawks separated themselves in high impact moments when it counted: third downs, red zone defense, and of course, turnovers.
Or none.
In Seattle's case, 0 turnovers all playoffs.
Exactly. And, retirement actually works the same way. Your success isn't defined by average returns over 30 years. It's defined by what happens during critical periods. The first decade of retirement is super important. Prolonged market volatility, major tax shifts that we don't have control over, and even things like unexpected family or health events. And that's where retirement plans are truly tested. Again, for high net worth families, the myth of average returns, maybe say 7% or whatever that might be, is especially dangerous for 3 reasons. 1, complexity. Your wealth is spread across multiple asset classes, different tax buckets, and even legal structures. And average returns don't reflect how these pieces all interact. Number 2, withdrawal dynamics. So when you begin distributing significant income, the math changes. Volatility combined with your withdrawals can permanently impair capital. And that's where you can have a downward spiral. And then number 3, tax drag. So at higher income levels, taxes become one of the largest determinants of your net returns. So 2 portfolios with identical gross returns can produce radically different outcomes after taxes are taken into account.
Let me ask our listeners a question. If your portfolio experienced a prolonged period of mediocre but not catastrophic returns, would your lifestyle remain intact? Most people have never stress tested that scenario.
Exactly. And again, when we worked with Jim and Pam, we didn't chase higher returns after they moved over to us. What we helped them with is we restructured their strategy around 3 pillars. 1, an intentional income design, something where they can safely take withdrawals from their portfolio regardless of what's going on in the market. Number 2, tax-aware asset location and distribution planning, making sure that we're doing things for a reason, whether that's an IRA, a Roth IRA, a regular account. Those things do matter. And 3, risk segmentation, separating growth capital from lifestyle capital. So you need to make sure you have maybe a couple different buckets, one for more short-term investments where you need income for your lifestyle, and one for more growth, which is for down the road in the future. And the goal wasn't to outperform the market. It was to make their lifestyle independent of market cycles.
So instead of hoping the averages worked, they just built a plan that didn't rely on them, right?
Exactly. And the shift was immediate. So, after we made those shifts, they stopped asking, what did the market do this week? What did it do today? And being anxious over that, and started asking over time, is our plan still working? And that's a very different mindset in retirement.
Absolutely. Well, if you're listening and thinking our situation isn't exactly like that, but it does feel, uncomfortably close or just some similarities, you're not alone.
And if we've spoken with you before, maybe months ago, maybe years, this might be a meaningful time to revisit that conversation, because in wealth planning, timing matters. A plan that made sense 3 years ago may not reflect today's tax environment or market conditions or personal priorities.
Sometimes the most strategic move isn't changing advisors. It's truly deepening the strategy.
So if today's conversation resonated with you, we'd be happy to schedule a one-on-one complimentary consultation to discuss your unique situation. You can call us at 888-4-MY-WEALTH to schedule your complimentary discovery call.
Or you can also explore our approach at morewealthmanagement.net. Don't forget there's 2 O's and more.
And if you find these conversations valuable, follow More Wealth Retirement Talks on Spotify, Apple Podcasts, Amazon, and on our YouTube channel. And share it with someone who values thoughtful planning.
Yes, and don't forget, you can also call our office to request a complimentary copy of my book, Retire with More, or you can also find that on Amazon as well.
Remember, listeners, at the end of the day, wealth isn't about averages.
It's about intention and purpose.
And clarity.
And don't forget confidence, most important.
Absolutely. Well, this is More Wealth Retirement Talk, and we do truly appreciate you spending part of your day with us.
And yes, everybody, go Hawks.
Go Hawks. Thanks for tuning in to More Wealth Retirement Talk with Shawna,
Dave,
and Jacqueline.
We hope you enjoyed the mix of financial insight,
sports wisdom,
and a few dad jokes along the way.
Join us next week for more ways to plan smart,
laugh often,
and retire with confidence.
Advisory services are offered through More Wealth Partners, LLC, an investment advisory in the state of Tennessee. Insurance products and services are offered through More Wealth Management, LLC, an affiliated company.